has investors wondering if this summer's rotation into small cap stocks is over. Joining us now, Carey Hall, BofA Global Research Senior U.S. Equity Strategist and Head of U.S. Small and Mid Cap Strategy. Like so many things, Joe, it's something can happen and it can be exactly what you want, but then it usually has like a but. It's got a but. But at the same time, this is everything. So we thought that inflation slowing would allow the Fed to cut rates, which would be good eventually for the small caps. So we started seeing the rotation. But if they're cutting much more quickly than they thought, or needed an emergency cut, or needed 50 basis points, then you're talking about an economy that's actually slowing, which would hit the E side of the small caps. So how do you gauge which is a headwind, and is it the headwind always worse than the tailwinds, or the tailwinds can win out? How does it work?
Right. Yeah, we talked to a lot of investors, and I think the Fed and confidence in the Fed cutting was sort of one necessary condition that investors were looking for to get more bullish on small caps, and that's what we saw as one of the key drivers of the rally.
Yeah.
The other thing that we've been highlighting for the last several weeks that we think is sort of the other necessary condition for the rally to be sustained is if we see an improvement in the fundamental story, because I think what's worrisome is that in the beginning of the year, everyone was expecting that by this quarter, small cap profits would have recovered, been positive, been outpacing large caps. That hasn't happened. Estimates have continued to get revised down for small caps. So there's a big expected pickup in profits growth in the fourth quarter that we don't know if it's going to materialize. And trends this earnings season haven't been that great. Guidance has been much weaker for small caps. Sales have missed. We've seen a record negative spread in corporate sentiment on earnings calls between small and large caps in the history of the data we've been tracking. So I think until we can see a shift in those fundamental trends for small caps, we've been saying the rally could stall. If we see a better shift, and obviously watching the macro data, as you mentioned as well, because indicators like the ISM have been declining. That's a very correlated one with small caps. We're still not expecting a recession or recessionary rate cuts. No, still expecting a soft landing, so still expecting the economy to remain resilient. But small caps have been in this earnings recession that just never quite recovered the way that large caps are now starting to. So, the economic data will be important for that as well.
It sounds like you're saying that the rate cuts are what you were hoping for and what you were expecting. Maybe 25, two of those before the end of the year. That'll allow. That would mean the economy stays soft landing, stays, it doesn't, no recession, so that the earnings numbers for the small caps should be expected to be okay or improve. But in the past, it always hasn't happened. Why has there been an earnings recession in small caps?
Well, we had both large and small caps in an earnings recession last year. It was a period where we've seen parts of the economy weaken. We've had these periods in the past where you've had, for example, manufacturing recessions, but not a full-on economic recession. Small caps have also sort of deteriorated in quality over time, at least when you're looking at the Russell 2000 index. About a third of the companies have no earnings, and we obviously saw them get hit during COVID, then another earnings recession, most recently. So typically their earnings recover faster than large caps, but we haven't quite seen that.
So bottom line, the nascent rally, a divergence rally. I mean, small caps were doing really well. There was a rotation. Is that continuing, or it's already run its course?
I think for now we see a pause until we can see more confidence in those fundamental trends turning around. And the economic data holding up, obviously, as we are expecting a soft landing, like I said, but obviously watching the data, since things can change. So, I think the way to position right now is there are still parts of small caps that are still well positioned. I wouldn't buy the Russell 2000 index necessarily, but I think, focusing on the stocks that have been able to beat and raise, focusing on stocks that are simply, revising estimates up in an environment where forecasts have still been coming down, focusing on quality, which is a hedge against volatility. Volatility does typically rise at this point in the year in election years. Some of those areas of small caps are still poised to outperform.